This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of December 16th to December 20th, we're taking a look back at the hits and misses for commercial real estate in 2024. We're calling it the successes, setbacks, and surprises. So, Manus, if I had some music, I would do that, retro music where you go back in time. It's now 2023. We've had a pretty dismal ending to the year, and we're about to launch into 24. Give us kind of a quick, where are we? It's the beginning of 24.
I think it's a tale of two markets in many ways. I think there are certain people out there that are extraordinarily happy. Equity returns were terrific. Bitcoin is up. Property values are way up in the residential side. So if you're a homeowner, you've seen the value of your home continue to climb. And then there's the other side of the coin, which is the market in which we operate, the commercial real estate market, which has improved, but haltingly. I think we're still very much in the doldrums when it comes to economic activity. Certainly it's better than a year ago, but nobody's popping corks in the CRE market. So depending on how you put food on the table every month, I think you probably have a very different perspective.
So in many ways, 2024 was a tale of two halves, really, right? 23 shifted into 24. We were very optimistic. We expected a lot of rate cuts and the market was going to come roaring back. That isn't really what happened. And yet there were some positive things that happened towards the second half of the year.
Yeah, I think the fits and starts were the narrative in the first half, as you said, and there were some reasons for optimism in the second half. If we go through how the year unwound, we started the year kind of with a lot of optimism. Dianne reminds us periodically that there were some analysts in late 2023 that thought we might see 6 rate cuts starting as early as March when we came into the new year. Certainly that did not take place. We didn't see our first rate cut until September. We saw interest rates really hit a near-term trough late in December 2023. That made people believe that the CRE market was going to take off. We started the year with a lot of optimism, and yet that stalled very quickly. The rate cuts didn't come. Interest rates quickly went back up again. And we really had to wait until about August before we saw real signs of progress. Yes, the LightBox commercial real estate activity front ran this a little bit. We started to see some modest upticks in activity in April, May, and June, and that was nice to see. But we really only started to see optimism emerge for the market in August. We saw interest rates really fall. They fell to as low as 3.6% in September for the 10-year. But even that second half, Martha, that you're referring to, even that had its fits and starts. We had a real wave of enthusiasm with that 50 basis point rate cut in September. The 10-year Treasury hit a multi-year low. People thought it was risk back on. The deployment of capital was going to accelerate. And yet after that 50 basis point rate cut, it's been nothing but a march upward for interest rates on the long end. So I think that you look back on 2023 with all of that and you think, what could have been? What could have been with some of these lower interest rates taking place, with the government perhaps spending less, with the deficit not being as large as it was? I think it was a missed opportunity for the market to get back on firmer footing in 2024.
And you bring up a good point there, Manus. That really hit the nail on the head. And that was, I think, a lot of the optimism from last January really hinged on the timing of the interest rate cuts. So in preparation for today, I looked back at what we had in the LightBox 2024 predictions report, which we come out with in January. And we talked to, maybe a dozen experts out in the field and different segments of commercial real estate. And all but one was predicting that we would see the first interest rate cut by the second quarter. And I remember a few even expected the first cut to happen in the first quarter, as shocking as that sounds now. And so I think a lot of the forecasts that the second half would be busier than the first, that this momentum would build, I think all really hinged on that expectation that Powell said last December that the Fed was nearing the time to lower rates, but nobody predicted that that wouldn't happen until September, except maybe Ryan Severino. He was the only one I remember who said 4 to 5 cuts in 2024 is too many, and I don't think the first one's going to happen until the third quarter. So I think a lot of the forecasts for bullishness this year really were based on that expectation that rate cuts would have happened much sooner than they actually did.
When you look at it in totality, and this is really true regardless of what year we're talking about, but it seemed more true in 2024, is just like the old song when you were a kid, the ankle bone is connected to the shin bone, right? The shin bone is connected to the knee bone. It's the same thing with CRE and broader economic indicators, that you can't disconnect CRE activity from where the 10-year Treasury is going, right? That's connection number one. You cannot disconnect the 10-year Treasury from how the economy in the U.S. is going. And for the last 3 or 4 months, the U.S. economy has been surprisingly spry. The numbers, whether you're talking about CPI, PPI, retail sales, continue to come in modestly hotter than people were expecting at this point in the economic cycle. And you also can't disconnect the 10-year Treasury from government spending. This $2 trillion deficit that we've been running for many years, and for a long time, it was north of $1 trillion. So, we're talking about years and years of excess spending. You can't expect interest rates to really fall when you're asking investors to write checks of $200 or $300 billion every month to finance the U.S. debt. So this is all interconnected. And what I fear about 2025, and we'll get into this a little bit later, is that this will be the narrative for the first half of next year, that we won't cut spending nearly fast enough. The government will remain running big deficits, and the U.S. economy will chug along in ways that put pressure on the Fed to keep rates higher than longer, as Spencer Levy noted in our podcast 2 weeks ago.
So we are an optimistic bunch, as we've said many times. We're going to start with the successes of 2024 and give ourselves a grade for some of the segments in the market that did well.
We have 5 or 6 categories to touch upon. These would be the winners, or the winning conditions, if you will, of 2024, things that put smiles on our faces, made us feel good about where the market was, allowed us to feel like things were better than they were a year earlier. And one of those things is the lending market. In 2023, we saw the failure of Silicon Valley Bank. Lenders really pulled back. Many regional banks were concerned about deposit runs, and that led to the deployment of cash being uneven through most of 2023. I think 2024 brought a return to normalcy. Banks were back at the table making loans. People that needed to get quotes in 2023, maybe they were getting 2 or 3 quotes. Now they were back to 10 or 15 quotes. We saw a contraction in risk premiums. We saw spreads come in. So borrowing costs came in as more lenders were fighting to make loans. We started to see a little bit of CRE CLO lending. That was good. The part of the market from private equity that serves the non-traditional types of borrowers came back. And all of that led to a feeling that borrowers could get money. It helped out some borrowers that were facing maturing loans get debt at slightly lower costs. And we saw the return of construction lending. People could get money devoted to new projects, new ground-up construction, regardless of asset class. So a lot of good things came out of 2024 on the lending front.
I think coming out of the gate, the lending wheels were really slow to start moving in 2024. The Mortgage Bankers Association's data for the second quarter is that commercial real estate lending was up only 3% in the second quarter. But then by the end of the third quarter, the end of September, lending volumes were up 59% year on year. So that was a huge jump. And I think it was 44% over Q2. And a lot of that, I think, was the excitement that was starting to build as it became obvious to the market that that long-awaited first interest rate cut was around the corner. But remember, we've talked about this on pods before, that the MBA forecasts that commercial real estate lending would hit 26% this year versus last. And I think given the slowness in the first half of the year, I'm not sure that they're going to reach that. we'll see what happens, especially with the 10-year Treasury back up again.
And it was all very welcome. We know how 2023 was for loan originators, how hard it was to get deals closed, to deploy capital and so forth. So we're happy for anybody in the loan origination space that was able to put up somewhat better numbers in 2024 than 2023. And a hat tip to the CMBS market, which had tremendous volume in 2024. I think we went north of $100 billion there. It became the lender that stepped in when banks were not stepping in. And what was really noteworthy is that the CMBS product, by and large, through its history, has been a 10-year product. They make 10-year loans for borrowers that want long-term financing. When rates were high, that financing was not very desirable. Who could blame you? Who wants to lock in 10-year debt locked in with prepayment restrictions for 10 years when rates are high? The CMBS market pivoted to have a much more palatable 5-year product, and that helped them grow volume in 2024. So nice innovation there that kept the market quite liquid last year, or this year, I should say.
I think the word of the year for you, Manus, was intrepid. I'm going to have to go back and count how many times you used that word, but it was your favorite.
Yes, for all those college students that are listening in commercial real estate programs across the country, you have your latest drinking game. You could say, how often does Manus have intrepid coming across his lips in a given podcast? This is more a level, not so much of success, because it's way too early to see how these things play out. It's more of a comment of admiration for those that took the plunge in 2024, and they were plentiful. Developers across the country took deep dives into buying distressed offices at 30 cents on the dollar with the belief that they could reposition these either as offices with more amenities, or really redevelop them entirely, turn them into residential or some other asset class. So it'll take a couple of years to see how these play out, to see what kind of returns these developers put on the board when all is said and done. We know that coming out of the great financial crisis, those that deployed capital in 2010 to 2012 were richly rewarded because the market needs this, because it needs courageous developers to come in and redevelop obsolete offices. My admiration goes out to them, and I hope that when the dust settles 2 years from now, they too put up really impressive scores on their return on investment for making these bets.
I hope you're right. I think, we can add to the list of successes this year too, Manus, the much uttered phrase adaptive reuse. The commercial real estate market is at such an interesting time post-pandemic, not just because of the market's adjustment to very high rates, and now, of course, we're going to hopefully blip back down to lower rates, but also just this evolution across different asset classes in terms of what kind of offices do we want? Where do we want to live? Where do we want to work? Where do we want to play? And because of that trend, it's creating opportunities for redevelopment and adaptive reuse, and converting, whether it's office to resi, which is really starting to take off, hotels being repurposed for affordable housing, malls, as we've talked about in various pods, becoming medical centers or live, work, play developments. And I think we're going to see, especially with the housing crisis, local governments really stepping up and trying to incentivize developers to step in and address the housing crisis with new redevelopment. So I think that's been really a glimmer of hope in the market this year, and it's certainly a trend that I think is long-term.
And I think for property owners and borrowers, we're feeling a little bit closer. I guess this would be another success to morning in America. We've been through now close to 3 years of downturn since about March of 2022, when inflation started to become a very high topic of concern, and shortly thereafter when interest rate hikes began. I do feel that falling risk premiums, slightly lower 10-year Treasury rates, more lenders out there, we're getting closer to dawn on property values rebounding. I don't think 2025 is going to be a cork-popping event, but I do think the second half of 2024 set the tone for more modest improvements next year to the good for borrowers and property owners, et cetera. They could use another uptick in the first half of next year.
Agreed. And I hearken back to what Spencer Levy said on our podcast, that he predicted that 2025 would be better, but not a banner year. And I think a lot of the signs are pointing to that. And I agree with what you just said on that basis.
And one of the measures that we've looked at throughout the last year to assess how CRE deal making is doing is looking at the LightBox CRE Activity Index, which we've watched come from a very slow grind upward to some surges along the way.
That's right. And, as we near the end of the year, I looked back at the index to kind of think about, how did 2024 play out relative to what folks were saying in January, which we've just been talking about. And it wasn't a steady climb. It certainly wasn't the steady climb that many folks were predicting. It rose fairly high in January after what ended up being a 4-year low last December of 48.2. And then after a January uptick, it's gone up gradually, but in some months it was 2 steps forward, 1 step back. And for those of you who aren't familiar with the index, it's really an aggregate measure of 3 functions in commercial real estate that support commercial property transactions. It's a measure of appraisal volume, it's a measure of environmental due diligence, and it's a measure of property listings. So the extent to which properties are coming on the selling block, which was obviously very, very low. So I put a lot of stock in the fact that we've come a long way since 48.2 last December. Last month it was 80.5. And as I said, it wasn't the steady recovery, but we're in November 12.7 points above where we were last year. So that, I think, speaks to the building momentum that you mentioned, Manus. And it also reflects some guarded optimism. I think folks they're starting to get comfortable thinking about taking out new loans. Certainly there's debt capital available. I think if you're an investor, you're starting to get more intentional about looking at opportunities in the new year. So, we'll see what happens. But one final point I wanted to mention, Martha, was in the past 12 months, there were only 5 months where all 3 of those measures increased versus the prior month. And 3 of those 5 were in September, October, and November. So that tells me that the market is finishing stronger than it started, if not quite as strong as everyone expected last New Year's. But I think the market is now where many people hoped and thought it would be at mid-year.
If we look at the headlines this past year, certain property types got all the negative headlines, and obviously we're talking about office, but there were plenty of good stories to go around across different asset types.
Yeah, they always say in the news business that scary headlines sell, right? That bad news is what brings people to the newsstand to spend their buck on the New York Post or the Daily News. And accordingly, we saw a lot of negative headlines. Plenty of offices were selling at enormous discounts. Probably the biggest one was that one in St. Louis, which was a 96 or 97% discount to the 2006 sales price, the AT&T building. But there were many, many pockets of strength last year that shouldn't be dismissed. This is not a one-size-fits-all market where, unlike the GFC or the early 1990s, where property values and distress were really equally distributed, this is really office, recent multifamily, and then everything else. Delinquencies, according to Mike Haas at Credit IQ, remain really inconsequential, well below 1% in the industrial sector as of November 2024. When you look at things like multifamily that was not tied to recent purchases using floating rate debt, the performance there quite good. People that locked in fixed rate, low interest rate debt, either before COVID or during COVID, are seeing scant levels of distress. In the retail segment, yes, we still have noise in the malls. Certainly there's obsolescence when it comes to shopping malls, but in the broader retail segment, when you talk about grocery anchored shopping center, strip malls, those continue to soldier on. Self-storage, another area where delinquencies and distress is really, really modest. So all of that being said, there are real bright spots relative to the headlines when one pulls back the curtains.
And I'll add to that, Manus, that one theme that we've heard quite often on the pod, and it's not always reflected in the news headlines, is just how differentiated the market is right now. So, you just provided a really good overview of the major food groups, but within each one, there are a lot of nuances, and even from property to property. And I think the market is challenged right now to identify what a reasonable price is, for an office building. And certainly that's the biggest challenge that appraisers face because of the lack of comps, but that is getting better. And, with retail, I don't think a lot of people could have predicted that retail would be as hot now, especially coming out of COVID, when people were still talking about how e-commerce really clobbered brick and mortar stores. But guess what? Retail's hot again, and it's on the top, I think, of a lot of investors' lists, including investors that previously focused on office that have now really pivoted to pay attention to opportunities in stronger markets.
Yes, I went to a mall the other day for the first time in quite a while. I went to Macy's. I needed to buy a shirt for a dinner tonight. Going to meet some CRE colleagues tonight for an industry dinner. Looking forward to that. But in my detour for the week, I will have to say that now I've been to Kohl's and to Macy's in the last week. They're not making apparel for serious people anymore, or real people even. You go there and every shirt looks like you're meant to be walking around as though you just got out of bed. The shirt's already wrinkled, or it has polka dots on it, or it's made for like an Olympic gymnast, right? Somebody who's built like a V and 140 pounds. And I have to say, like, there's a market opportunity for somebody to go back and just sell those white button-down Oxfords with a nice comfortable collar and fit for a person like me with the dad bod. Where is that retailer?
You're dating yourself, which is a perfect segue to our Setbacks segment, which will begin with a musical interlude of Frank Sinatra, no doubt.
Well, I think I front ran the interlude by suggesting that I don't have that 21-year-old lithe gymnast body that I could fit into that V-shaped shirt. But yes, in the setback side, Frank Sinatra used to say regrets he had some, but too few to mention. Sadly, in the CRE market, we have to mention some because they are worthy of mention. There were certainly plenty of setbacks during the course of the year, and we'll run through those over the next 15 minutes or so. Setback number one, I alluded to earlier, it has to do with interest rates and the halting nature of the declines. We saw major declines in interest rates at the end of 2023, again in April, and again in August and September, only to have rates tick back up in the ensuing 2 or 3 months. 10-year Treasury, 360 in mid-September. 60 days later, it's back up to 4.5%. I would say that that's a big setback. When you talk about interest rates and the Fed cutting and lower rates coming, you want to see a steady march lower month after month after month. And we saw none of that. We were up and down, oscillating throughout the year, and that was one of the setbacks. Dianne?
I'd agree with that. And I think that's why it's been such a bumpy road this year. Things didn't necessarily move in the expected way month to month. And when you're talking about coming out of a recovery, the hope is that you do it gradually, or at least consistently. And it was a nerve-wracking year because there were these sometimes surprise vacillations, whether you're talking about the 10-year Treasury or, our CRE Activity Index. It wasn't always linear. And I think that was very frustrating for the market. But hindsight's 2020. When you look back, you think, well, of course, because, there was uneasiness leading up certainly to the election, which we haven't even talked about yet. So it was a dicey year, and kudos, like you said, to the intrepid risk takers who jumped in the water, regardless of market jitters, that we really saw fairly consistently in Q2 and Q3 especially.
I think another setback, which goes hand in hand with this interest rate oscillation, is the fact that we've seen this leveling off and even uptick in CPI and PPI. That too is not going to have a straight line down to 2%, which is what the Fed wanted to see. What we're hoping for now is that the worst of all things doesn't happen when we see a reacceleration of inflation. Yes, we've seen a couple of upticks in recent months, A 10 basis point uptick is not a 50 basis point uptick. If we stay here and we level off, probably not the end of the world. What we're hoping for is that all this government spending, the Fed being dovish for the last couple of months, doesn't lead to another uptick in rates. The worst case scenario is we start heading north again. Best case scenario is the decline that we saw over about 2 years or about 18 months restarts again next year. Let's keep our fingers crossed.
Yeah, indeed. I've been asking a lot of people that same question, Manus, which is, what do you perceive as the worst case scenario in the near term forecast? And almost always their answer is, my worst case scenario is if Powell has to raise rates again. So I agree with you. Hopefully we won't get to that point.
My worst case scenario, going back to my previous remark, was last night when I spent $70 on a shirt that doesn't even fit and doesn't look good, right? How about that for just sheer disappointment, right? I picked up a sweater, right? Thinking, oh, I'll get a nice sweater to go with this ill-fitting shirt. And I said, oh, this is a pretty nice shirt, sweater. This is nice navy blue. It'll look nice, whatever. And it says Scotch and soda across the front of the sweater. Like, who has Scotch and soda written across a sweater as like a fashion statement? You just can't be too careful these days.
I'm more concerned with the ugly sweater trend. I don't get it. It seems like an unnecessarily high volume of clothing that people are going to wear maybe once a year. I'm completely baffled by that.
I've never gone out of my way to get an ugly sweater, but my kids would probably say that I go ugly with my apparel 365 days a year, that I just don't care. And there could be something to be said for that. Although yesterday I cared. Yesterday I said, I don't want to wear this shirt and I have no choice. Everything else is at the dry cleaner. And hopefully I don't get mocked tonight.
I think you need a bigger closet.
I probably need a fashion consultant somewhere along the way. Maybe so one of our listeners can offer some help. Maybe somebody who's met me at a conference and just could immediately see me walking down the hallway at the Fontainebleau in Miami and say, God, what that guy needs is, feel free to share, listeners.
I was going to say, Martha, maybe this is a good time to remind our listeners of the email and we can get some fashion suggestions for Manus.
Yes. We'll have to send him a photo first, though.
Yes. How do people reach out to us, Martha?
Send all your fashion suggestions to podcast@lightboxre.com. Attention, Manus.
Feel free to include photos or links to places where I can get this online. Happy to do so. Let me lastly close out our setback segment, which we can't ignore, which was the uptick in distress during the course of the year. Mike Haas, again, of Credit IQ, my second shout out to him this week. He shared his numbers with me a short time ago, year over year, and the numbers are really growing in certain categories. I'll read some of them off now. They are alarming. Starting with the office segment, where we were in November 2023, distress, which he defines as the sum of loans that are delinquent and loans that are with the special servicer. Sometimes a loan can be current, yet with the workout specialist. So this is the summation of the two. Office in November of 2023, 6.8%. The latest number, November 2024, 15.5%. So almost a 2.5x increase in delinquency. The other one that jumped out, multifamily, it ended last year at about 4%. As of last month, November 2024, north of 11%. A lot of that is what we've talked about all year long. This is the syndicators that bought at peak property values with very high leverage, using floating rate debt and extremely rich income projections for the ensuing 5 to 10 years. Those are the ones that are running into trouble, and it's being reflected in the Credit IQ numbers, north of 11% in multifamily. When you compare that to what Fannie and Freddie shows you, or what banks show you for their balance sheet loans, or fixed rate CMBS multifamily, the numbers are still well in the low single digits. Just as malls are different from shopping centers and grocery anchored, in the multifamily, it's syndicators and floating rate debt operators and everybody else.
And just one other thing to add on the office, Manus, I think, distress was very slow to materialize. And I think certainly it's going to get worse before it gets better. And the pain wasn't limited to obsolete Class B and Class C offices.
We certainly saw plenty of examples of trophy offices that, because of the loss of a major tenant, saw their values drop by 40 or 50%. And it wasn't limited to New York and Chicago. It was LA, San Francisco, Charlotte, Pittsburgh. Everybody had their story. Seattle, Portland. No market was really immune in 2024 from these risks.
Agreed. And I think, if there was a silver lining, it was a point we've talked about on pods before, which is after several years of retrenchment from some of the biggest tech firms, Amazon, Facebook, Google, Microsoft, they all saw revived appetites for CRE space in 2024. So it wasn't all doom and gloom.
Yeah, I think, well, we'll get into this shortly. We'll talk more about office going forward. But I do think your point at the end, the revived appetite for those FANG stock firms was a nice twist last year.
And if we look back at the year, there was probably one certainty, and that was a lot of uncertainty. Despite that, there were some things that caught us by surprise that we think are worth noting.
I guess this is a continuation of the thought or the thread we were just having on office. I think the biggest surprise for me was the pace at which offices were getting resolved. When you look back at the last two depressions in CRE, the early 1990s and 2008 to 2010, price discovery took an awful long time, and resolution of distressed assets took forever. Many times, years and years and years, sometimes 5, 6, 7 years. What we saw in 2024 was a really significant number of properties selling and owners taking their castor oil immediately. That really took me by surprise, that borrowers threw in the towel, property owners threw in the towel, said, yes, I agree, this is worth 30 cents on the dollar, make me an offer, I'm ready to sell. Something we hadn't seen in past crises. What are your thoughts on that, Dianne?
I was wondering why that was as I listened to you talk. Are we smarter now? Are they figuring, let me just cut my losses and move on and not, not delay the inevitable? I don't know what the right answer is there, but you're right. That was a bit of a surprise.
It could be wisdom from past crises. There are people out there that say your first loss is your best loss. And what that means is if you try to chase your tail on a property that's seeing sagging occupancy, that needs a lot of capital improvement, that's running at a loss, you're really setting yourself up for a much bigger loss down the road. So we saw this in the mall space over the last 10 years, that maybe a $200 million mall, the first time it's revalued, it's $120 million, then it's $90 million, then it's $60 million, and then it's $30 million. And all along the way, the owner is trying to turn straw into gold, right? They're trying to make this thing work. And at the end of the day, what might have been a $60 million loss of equity turns into a $160 million loss of equity. And perhaps that's what's happening now, that the borrowers are just saying, look, we know how this plays out. We can keep pumping money into this thing, but it's good money after bad. Let's take our medicine right now and move on, fight somewhere else.
I think two parts of the market, and they're consistent with what the Fed is watching in terms of deciding whether they're going to go for aggressive rate cuts or not, is the labor market and the consumer market.
I think it's one of the big surprises. We're now a couple of years removed from all the stimulus out there, yet we're still dealing with very high prices on food and housing and so forth. So you would think that a couple of years into this expansion and post-COVID period that we'd start to see the consumer getting tapped, businesses getting tapped out, unemployment moving up higher than it has been, and spending declining. And yet the consumer continues to be very, very resilient. Unemployment inches up, doesn't race up. And while expansions or the avoidance of recession doesn't last forever, I have to say I've been surprised at just how long the decent times, the good times, whatever you want to call them, have continued as it's pertained to spending and unemployment.
Yeah, and just the overall strength of the U.S. economy. Obviously, all eyes from the Fed are going to be on what's happening on the labor market. I think the general expectation is that rates are going to go down one more time, and then after that, we'll see what happens. Obviously, the focus is on making sure that the labor market is strong and continues to be strong and doesn't start to kind of backpedal into worrisome territory.
I think what makes it so paradoxical, Martha, is that during the election, throughout 2024, you heard it over and over and over again. High prices are killing us. High prices for food, for insurance, for rents, for vacations. Endless amounts of people saying this is unsustainable. And you would think that that would go hand in hand with people tightening their belts. And it didn't. And so there's kind of like this disconnect here where, and I feel it, like when I go to the grocery store, I do feel like it's a $200 bill where 5 years ago it was a $100 bill for the exact same thing. And by the way, you only get 3 cookies instead of 8, right? Then like 5 years ago. But with everybody feeling that way, you would think that there would be a real downdraft on spending, and that hasn't materialized. I really can't explain that. And I hope it doesn't mean that when the reckoning comes, it's more severe than past downturns.
And that spending has now been given attention in terms of government spending, aka the deficit. And with Trump including his tariffs and tax cuts, everyone's trying to game out how that's going to impact the coming economic fallout. It'll be interesting to see how that unfolds.
There's a lot that can go wrong, and there's a lot that can go right in 2025. What can go wrong is if the president-elect goes through with his tariffs on a really punitive level, and that drives up costs again, that could be very, very impactful. Let's hope that this is posturing and not what reality turns into next year. But I also think that one of the really important things is if there's a silver bullet out there, if there's money to be found that allows the government to really squeeze down this deficit to a point where people say, wow, this is real progress in short order, I think this would push interest rates lower to the benefit of everybody. Does that silver bullet exist? Who knows? We're going to find out. I'm keeping my fingers crossed that the answer is yes. I'd love to see us start running deficits of under $1 trillion so we can start really at least leveling off our government debt, which is just really out of control.
So one of the last surprises is a fun story if you're a tourist headed to New York, something worthy of checking out. And that is what I think is the most on-brand construction site. The Louis Vuitton flagship store, about a month or so ago, had its scaffolding dressed up as a stack of Louis Vuitton luggage trunks. Pretty impressive.
That is really going the extra yard, I have to say. If you're going to have to put up scaffolding, normally it's inconvenient and ugly. And nice to see them going the extra mile to make the neighborhood a little bit more respectful or respectable during the holiday season. But that is an interesting trend you bring up, Martha, or an allusion to an interesting trend. More and more retailers buying their own buildings because they can buy things at such deep discounts right now. We've seen stories like this with some major U.S. retailers coming in, Uniqlo in Fifth Avenue buying their space. There was another one in Lower Manhattan, I think it was 620 Broadway, where the retailer brought their space. A lot of opportunity now for retailers to move from renters to owners, and that's maybe something that'll continue in 2025.
And yet another positive force in the retail sector, which we talked about before. And I would say if anybody's in Manhattan over the holidays, it really is a cool thing to see because it's just on such a large scale. And I read somewhere, Martha, that the trunks were rendered from 3D scans of actual Vuitton trunks. And each of the signature kind of metallic corners, each one of those is 7 feet tall. So when you see it in person, you realize just the grand scope of it all and the materials that went into it. It's you have to see it in person.
Very fun, worth seeing. And I'll take a minute to thank our listeners. We started the podcast this year. We're now being listened to across 41 countries, including the US, Canada, UK, Finland, and Hong Kong. And some of the top regions in terms of listeners are in New York, Los Angeles, Atlanta, and Dallas. So thank you so much for tuning in each week and listening to us. Some of the top episodes include Jamie Woodwell, Spencer Levy, our first episode, and the Fed rate cut episode. So thank you for that.
And certainly a thanks to all the people that work behind the scenes, Sophie and Alyssa and Josh, that pull together data and help us produce this every week. It's a great team that works here, and have to tip my cap to them for everything they do behind the scenes.
Hear, hear.
So hats off to our Lightbox production support team, Alyssa, Molly, Sophie. We couldn't do it without you. Thanks to our producer, Josh Bruning. We'll be off next week, but back with 2025 predictions on January 3rd. You can catch us on any of your favorite podcast channels in the interim, and send your comments or questions to podcast@lightboxre.com. Thank you for listening, and here's to all good things in 25.
Let's go.